Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be covering is why you should never pay cash for real estate.
I get that question all the time. A lot of our listeners and clients want to invest in real estate, and it's like, why should I run the money through a policy? Why don't I just go straight to real estate? And what I explained to him, it's we call it the and one, right? And if you're a follower of basketball, it's a basketball term. And what that means with and one means is when you're fouled while you're shooting a basket, if you make the basket, you get those points and you get one shot of a free throw, right? And then, so you have the ability to get more points, or we call the and one. So when you combine real estate with infinite banking, that's where we say that you can have the and one.
So what we're going to do later is we're going to actually go through the video that we did for the and one, where we're going to put some numbers to this. But first, what we're going to do is we're going to talk about the combination of whole life insurance and real estate. And what we found is that real estate is not liquid, and whole life insurance just does not create cash flow the same way that real estate does. But what happens when you combine the two of these, if you got the best combination of cash flow and liquidity that you can possibly find.
So doing that, you get the and one.
Oh, nice. So now what we're going to do is we're going to look at the 6 ways that you can create wealth when you combine whole life insurance and real estate. You ready?
Let's do it.
Awesome. Let's start with cash flow. When you look at cash flow in regards to real estate, is everyone understands that you've got cash flow that's coming in on a monthly basis. And this is probably the most important piece to real estate when you're looking at it, in my opinion.
Right. And with whole life, you can create cash flow with the annual dividends. But really where it bodes well with real estate is with being in real estate, you need some liquidity, right? There's going to be repairs, vacancies, and there's going to be other opportunities. You need liquidity and able to have that. And one of the best place that we know to store cash is inside a policy.
Absolutely.
Right? Now, the second one is appreciation.
And appreciation. This is probably where we differ than a lot of advisors out there, is that most people are looking at appreciation as the most important component to real estate. And we believe that is certainly tertiary, right? That falls down the list. But appreciation, if we can get it, it's kind of the cherry on top.
Yeah, and in whole life with the appreciation, there is a guaranteed growth. Not too many products can actually say that. There's a guaranteed growth, that this will not go down, that it will only go up. And also there's the ability to receive dividends as well. The companies we use have been paying dividends over 100 years.
Yeah.
So there's that guaranteed growth and the dividends.
One thing, if I can, I'm going to add on to that, is that whenever I talk about guaranteed growth with whole life insurance, is I love the fact that that guarantee is expressed in a dollar amount, right? It's not a percentage there. I don't know if there's any other product that does that, but to me, that's a big deal, because you can look at the growth in any given year and understand exactly how much it's grown by.
And this way you can have the same dollars both achieving appreciation in 2 different assets.
And the third item that we're going to look at is going to be the tax advantages of real estate. When you look at the income that comes off of any sort of rental properties, it's going to come in as passive income, and it's going to be taxed at ordinary income. Now, if you have that property and you sell it, typically it's going to be subject to long-term capital gains, which is one of the lowest tax brackets that you can be in. But then also what you have is you have the ability to depreciate that property. And we don't have the time now to spend on depreciation, but I will say that Tom Wheelwright has an excellent book. It's called Tax-Free Wealth. And in there he dedicates an entire chapter to depreciation. And in addition to that, he also has a chapter on the 4 or 5 different types of income. So if you guys have time, go check that book out.
Now, there's a lot of tax advantages to life insurance as well. You can have access to your cash value via loans and without paying taxes. In addition, the death benefit gets passed on to the next generation, without paying any income taxes as well. And as Cameron mentioned, there's a lot of great tax advantages of real estate, and there's some with life insurance. And when you combine those two, I do think that you're truly maximizing the tax code.
And the fourth topic that we're going to be looking at is going to be equity. Right? You can create equity inside of a mortgage in one of two ways. Number one is going to be appreciation, where it just rises in value, or number two is going to be the paydown schedule. And that's going to be either you making those mortgage payments or going to be one of your tenants.
You're also building equity inside your life insurance policy. And don't forget, your policy is an asset. And that asset will be on your balance sheet.
Totally agree. And we have both of these. Both assets will improve the balance sheet of any investor that's out there. Now let's move on. Number 5 is going to be looking at leverage, right? Leverage is absolutely instrumental in creating wealth over your lifetime. And we look at what happens with real estate is anytime that somebody has created a considerable amount of wealth over their lifetime, typically real estate is going to be involved. And when we look at that is making a small down payment, or an example of this would be making a small down payment to own or to purchase the entire asset. So let's say you put $15,000 down to purchase a $100,000 asset would be a great example of leverage.
Right. So you're putting in $15,000, but you're controlling $100,000.
Mm-hmm.
Right. And with your life insurance, this is probably one of the best things. I don't know about the best. There's so many good things, but one of the things that why this works so well, because again, your equity inside your policy is an asset and you can leverage against it. So this is where if you hear us talking about compound interest, right? Because when you take a policy loan, a key thing is you're not taking it from your policy, you're taking it against your policy. They're using your policy as collateral. You're actually borrowing from the investment arm of the insurance company. So what that means is, for one, you have immediate liquidity. You can get access to this money without a credit check, without a repayment schedule, or saying when and how you're going to pay it back. Only thing they're going to ask you is how much do you want and where do you want it sent. But because you're not borrowing, you're borrowing against your policy, you're borrowing not from it. That means your policy, what's happening inside the policy when you leverage against it?
It's continuing to grow.
It's continuing to grow. So this is why we never break that compound interest curve. So your cash value is still compounding even though we are using it.
Yeah. An example of this is using the same dollars for your premium payments as you would for the down payment on your house.
And this is where people get caught up the most when they're evaluating using a policy loan or not. And that's why we did this video that's in the show notes. We actually do the math to show you paying cash versus not paying cash. It's really telling the whole story.
Totally agree. Number 6, let's move on. We got a hedge against inflation. And what we're looking at is when you use real estate as a hedge against inflation is you're using long-term payments in your favor, right? And if you can secure a 30-year mortgage with a bank, there's no better way to kind of offset real estate than to use a 30-year mortgage. And one of the best explanations that I've ever heard on that was done in one of our interviews with Aaron Chapman. Mm-hmm. And so we'll make sure that we put that in the notes. If you guys haven't watched that, make sure you make the time to go back and review that.
Well, and with whole life is actually considered an asset that increases with inflation. Mm-hmm. Without getting too technical, when inflation comes, interest rates rise, and thus that also makes the dividends rise for the insurance company. Okay, but the real thing about it is being, again, I know I'm going back to leverage, but ideally you can leverage that policy to buy other assets, right? And then so where you're raising with inflation is not only inside the policy, but what you do with the policy as well.
Yeah. To summarize this is inflation works to your advantage if you've got a long-term fixed payment. And what I mean by that is if you have $1,000 a month mortgage payment now, it feels like $1,000. right? If you fast forward 20 years from now, that $1,000 a month mortgage payment isn't going to feel like $1,000. No, it's going to feel like 500, right? Or 600, or as it would now, right? So it almost gets easier to make that payment moving forward. And then if you compare that with life insurance, is you've got cash value and these monthly payments that you're sending to the insurance company that are growing in value every single time. So when you combine the two of them, it's a great it's a great hedge against inflation.
Perfect.
Yeah.
So now those were some of the top 6 reasons people invest in real estate. Right. So now let's talk about, let's briefly go through the video that we had created.
The and one video. Let's dive into it. So what we're doing is, like we mentioned before, is we're actually assigning some numbers and going through and doing the math. Right. Common question that we get is why should we not pay cash for real estate? And so here's some of the assumptions that we've made is we're going to purchase a $100,000 house. We're going to assume 3% appreciation. We're going to hold it for 30 years, and we've got monthly cash flow of $1,000 a month coming off of this property.
Yeah, and most of you on listen to the podcast might be driving or doing something. We're just going to talk this at a high level, right? But the video is when you'll be able to really see the details and how we came up with the math. But here we're going to try to just to summarize and use round numbers so Cameron can understand.
So in the first example, what we're going to do is we're going to go buy a house for cash, right? The house that I just mentioned, those numbers, we're going to go and pay for it in cash, right?
Right, and exactly, yeah.
You don't have anything to add?
Well, no, I'm going to add in a little bit. Add a little bit.
Okay. So do we want to go through the appreciation and the cash flow? Perfect. So the appreciation that you'll see when you watch the video is going to be $242,000. So that's $100,000 growing at 3% over a 30-year time frame. Then we took $1,000 a month in the monthly cash flow that's come off of this. So we've got $360,000 that's coming off of it. And then we paid $100,000 for this. So the total return is just over $500,000 if we pay for it in cash, right?
Perfect.
Awesome.
So what we're going to do here is we're going to buy the same house, but instead of paying cash, we're going to use a policy loan. But a couple things before we go any further, we're using, this doesn't just work with real estate. This works really with anything. And one thing Nelson, if you haven't read the book Becoming Your Own Banker, I highly encourage you to do so. But one of his main things is you finance everything you buy. You either pay cash and give up interest that you could have earned, or you use credit and you pay interest. So you either pay up or give up. Right. So, and this works really well with real estate, but this would work with anything that you are trying to buy. Like Cameron, let's say somebody got in to buy like a bulk of Paul Mitchell hair product, right? Couldn't they just, it's the same thing. You finance everything you buy. You either pay cash or a policy loan. So I know Cameron's used plenty of policy loans to buy Paul Mitchell product. But what we're going to do here is we're just going to focus on real estate. And in this example, just to keep apples and apples together, we're going to buy one house for $100,000. Okay. But really, is that what we'd recommend?
No.
What would we do?
Well, we want to go through and use the principles that we just covered, one of them being leverage, right?
Yeah.
So we don't want to come in and have a full cash purchase, right? What we want to do is we'd rather take that $100,000 and go buy 4 or 5 different houses at $15,000 to $20,000 a piece, right? Because now, right? I mean, you could continue that out and you look at the depreciation. You go buy cash for a $100,000 asset, you can only depreciate $100,000. If you buy 4 of those, you're depreciating $400,000. So,
right, exactly. So what we're going to do, so in the big picture, what Cameron just talked about, cash, the total return is $500,000. Okay. Now, when we have a policy, use a policy loan, well, the appreciation is still the appreciation, right? Cash flow is going to be a little less because what we're doing is we took a policy loan, and we do need to pay that back. So when we ran the numbers, we ran it like a 30-year mortgage. Okay, so when instead of getting that $1,000 a month cash flow, we have to pay the policy back, principal and interest. So our cash flow is going to be a little less. In fact, the cash flow is only going to be about 166. So it's about $200,000 less. Okay, now in here, now our net return is about 400 using infinite banking, and using cash was 500.
Mm-hmm.
Right, and the biggest mistake is if somebody looks at it right there and says, you know what, this is stupid.
Yeah.
Right?
I'm losing 100,000.
Right, exactly. But we got to look at the big picture, all the moving parts. We just looked solely at that house. But Cameron, what's going on inside our policy?
It's growing.
Right? It's growing. It's continuing to grow even though we used it. So 100,000 growing at compounding at 4% for 30 years is $324,000. Okay. So if we subtract the 100 grand that we put in the policy originally, that growth between the net return of using IBC was 633,000, and paying cash was 500,000.
Mm-hmm.
Now, to me, I'd rather have 633 than 500.
Me too.
Okay, good. Okay, that's a difference of $131,000. That's 26% more than paying cash.
That's a huge difference, right? And like you said, I hope that this video helps people understand the big picture. Right, because I think a lot of people might get to the first or second step when they're analyzing some of these things, and they start to compare numbers, and they go, it doesn't make sense. We just didn't go far enough, right? And so hopefully this video takes you all the way to the end and shows that if we run cash through a policy and buy a cash flowing asset, we're always going to come out ahead.
And to me, here's a couple of things I'd like to summarize. Paying cash or using a policy loan, did we put more cash in IBC?
No.
Did we work any harder?
No.
Did we take on any more risk?
No.
And we had more money.
Yeah.
That's called the and one, right? Is just doing the same thing you were doing, but by just doing it a slightly different way, we're going to have more money.
Absolutely.
And also, who paid less in taxes, Cameron?
IBC.
Right? Why?
Because we can deduct the loan interest on our policy.
Exactly. If you remember what I had said, the cash flow difference between cash and IBC was about $200,000.
Mm-hmm.
That $200,000 was interest. And interest is tax deductible. So $200,000, let's say you're in the 25% tax bracket, right? That's about 50 grand. So by using IBC, you can make 130 grand cash plus another 50. Again, I tell you, when I do that, I get fired up.
Yeah, I can tell. That's a $180,000 swing.
Yeah, and to me, and I get it when you're evaluating it, but that's why we do the math. And to me, the winner is who has more cash at the end of the day.
Mm-hmm.
In this example, we did it over 30 years. Most people probably aren't having a house or a rental property for 30 years. Maybe they should, but maybe they don't. But Cameron, what do you think who would be ahead, let's say, if they sold this after 10 years?
Oh, the IBC strategy.
Why?
Because they've got the policy. And in conjunction to what they're doing on the real estate side, as long as you've got that policy sitting there earning, compounding for you in the background, you're always going to come out ahead. In the IBC strategy, you've got two assets, not just one.
Exactly. So what we would recommend you do is to watch this video and check out the math, right? And if this is something you're interested in, maybe you're not sure, well, hop on a call with Cameron and I, and we're doing a discovery call and kind of see what your goals are, and see if we are a good fit for you to help achieve those faster and with less risk.
Awesome. Hope you enjoy the video.
Make it a fantastic day.
Take care.